So just to give you a brief introduction about myself, I am V. Kamalesh, attached to Commercial Bank Finance Department, and I have been doing this program for almost now 5 years, 6 years actually. So this subject, of course, is something which is evolving from day by day. And let me give you a brief introduction of this subject before we commence with the course material. This is, of course, you need to understand a subject where you are tested on the overall application of the accounting knowledge. So we are here going to do a session for about 20 odd weeks or so, which will help you to understand the basic accounting concepts and the principles and the application of same into your day-to-day business operations. So especially for people who are in the field of doing credits or credit appraisals, this is more important because we will do a financial statement analysis, which will be very useful for you all to understand your customer better. So when you have a corporate or maybe a client who is running a business where they will furnish you the financial statements in order to get the loan, so you need to be in a position to understand the financial statements better for you to give a good evaluation of the customer. So with that in mind, we should also remember that this is not a qualification which is going to be as such where you will have the in-depth knowledge of accounting, because there may be instances where we will go into detail and go into the nitty-gritties of relevant chapter, but there may be situations where we will touch upon the high level information. For example, I would say if you look at an accounting standard, we may not go in detail into the standard because what is relevant for this subject will be touched upon. So you don't need to worry about, we didn't go through the standard in detail because there are more and other examinations which does that. So the focus of this topic is to give you overall knowledge about business accounting, and especially with regard to in the application of your business evaluations of your customers. So with that backdrop, let us go to our topic. I hope everybody is clear with what we are going to go on from here for the next 20 odd weeks. And I'm now going to share you the presentation. I hope that is already available with you all. And we are going to start with the session. So we are going to start with the first topic, which is basically talking about the business organizations and business environment. So as an accounting body or a bank where you all are attached to, it is very important for us to know what are the organizations that are built in the market, or in other words, the customers, type of customers or the business organization that we may have to deal with in our day-to-day operations in the bank. So there is a direct relationship between accounting and the business. Why would I say that is? Every business concern has to be accountable. So the end of the day, the result of your business is produced in the form of accounts, which is in other words called as the financial statements of your business. So the business performance is evaluated by way of the function which is called accounting, and the output of accounting is what makes the business more prominent. So as a result, the accounting may not exist if the businesses are not there. So businesses have become more and more important to support this course of accounting. The business or the business organization in a broader perspective, where an entity which continues with profit-making motive. We need to understand this very clearly. The motive of most of the businesses are to make profit. But for that matter, we do have non-profit making organization also. For example, there are charity organizations. So the charity organization, the objective of those is to support and help the community. So the business or business organizations mainly focus on making profit. And there could be organizations which manufactures goods and services and sells them and distributes them. For example, let us think about Mass Holdings, where they manufacture garments, they sell, and they do also a distribution. So their business needs to be accounted or evaluated for their business performance. Thirdly, we can also look at an employment generation entity, an entity which generates or creates employment opportunities to the society. And lastly, a process that develops the wealth of the investors. So another motive of business organizations is to create wealth of the investors. Why people come and invest in businesses are to make more wealth for themselves. So it is very clear that the business organizations have these kind of motives in their respective business organizations. Now we look at an organization. What is an organization is? So these terms, businesses, business organization, and organization are interchangeably used, but all those have a slightly different meaning compared to the other. An organization is a social arrangement which pursues collective goals, controls its performance, and has a boundary separating it from its environment. So it's very clear the organization is a social arrangement which pursues collective goals. The meaning of collective goals is if there are 5 people, the organization tries to achieve the goals of all 5 people. So the examples that are following, you will understand more about what an organization is. Let's say a multinational manufacturer. A multinational manufacturer means a person who is manufacturing products globally and having a distribution. But secondly, a local product manufacturer means who is producing goods to cater to the local market. Thirdly, we might have a local authority. Say for example, the electricity board. The electricity board is with an objective of serving the people to provide electricity without any interruption. So there is a goal, clear goal defined for these authorities. And next example is a charity. As I mentioned earlier, what could be the objective of a charity? As we understand, a charity focuses on the well-being of the society. So what is the clear goal there is serving the community or the society or the environment to make it a better perspective. And lastly, but we know this term, a trade union. As most of you might know, even in banks, we do have this. What is the objective of those? It is to safeguard the interests of its members. So a trade union is also an organization which safeguards the interest of its members. So it's very clear the organization is an arrangement where people are concerned, which pursues the goals of them collectively, not one individual person's goals are tried to be achieved. It is a collective goals where it is achieved through this organization. So how do we identify these organizations? Now in the business world, we do have several organizations, but how do we segregate one from the other? So there are set criteria which will give us an idea of how each of these organizations behave. How do they operate? So that gives you an understanding of the operation that the organization is carrying out. First of such criteria is the ownership. As we know, the organizations can be broadly categorized into two. Some are owned by private owners or shareholders, which I will explain in detail later on who is a shareholder is. And these are known as private sector organization. Now, if I talk about private sector organizations, now we know that most of you all are joined for this program might be working for banks, which are called as state banks, which mostly covers the Bank of Ceylon, People's Bank, and so on. So just to make you all understand, only I'm quoting these names, but any other bank which is normally known as a private sector bank. So which means these banks are owned by private owners or shareholders. But the other category of organization, when in terms of ownership, is where I call public sector organizations. So it's very clear what is public sector organization is where the ownership lies with the government. So when it is not owned by the government, it is going to be called as a private sector organization. Private sector organization. But you might ask the question, can there be a situation where both could be there? Yes, of course. There can be situations where the shareholding or the ownership is partly held by the government and the balance portion is with the private sector companies or the shareholders. So there could be a situation like that also. But broadly, we categorize these organizations into two, which are namely as private sector organizations and public sector organization. What do we understand by them is a private sector organization is where the ownership is with the private owners. In the case of a public sector organization, the ownership is with the government. The second criteria to identify an organization is the control. So who is going to control this organization? Some are controlled by the owners, but many are by people working on their behalf. This has to be understood very clear. So in companies where the company is controlled and run by the owner itself, say for example, somebody running a grocery, which you all might know, we call it as sole proprietorships, where the person who has set up this business is the owner. So he is the one who is going to make all the decisions on behalf of the organization. But there are organizations where the owners may not make the decisions, but there will be people who will be making the decisions on their behalf, where we call them as, for example, if you look at your respective organizations, which are the banks, you have a team called board of directors. Who are these board of directors? The board of directors are the people who are appointed by the shareholders to work on their behalf. So the shareholders become the owners of the company or your respective bank, But who is going to run the business? It is the board of directors. So the board of directors is the people who are going to work on behalf of the shareholders. So the controlling here means who is going to control and run the business. And thirdly, we can make use of the criteria activity, where we need to understand whether the organization is into manufacturing goods or providing services. Now we need to understand this very clearly. What are banking? Banking, is it a product or a service? We know very clearly it is a service. We call that as financial service. We provide financial service. In order to deliver this financial service, we have defined our own products. But we don't manufacture products. But there are organizations which manufacture goods. Say, for example, Damro. A very good example I can think of is Damro, where they manufacture furniture as part of their business. So their business activity is manufacturing furniture items to be consumed by the public. The activity only is going to determine whether this is a manufacturing organization or a service organization. And the next criteria is where we talk about the legal status. The legal status, where there may be limited companies or partnerships. So when you say limited companies, means where there are companies which are set by people, including shareholders, and those are limited in terms of liability, which we will discuss in detail later on. But partnerships means where there are more than one people getting involved in order to run a business. Again, these two concepts we will learn in detail later on in the program. So the legal status determines whether this is a limited company, limited by liability or unlimited by liability, or this is a partnership. This is a partnership concern. And the next criteria is the size or scale of the business. So the businesses may fall into different categories. For example, there could be a business which was set up by a family. We call them as family-owned businesses, where the father or the grandfather would have set up the business, and subsequently the father running the business, and then the children running the business, and it goes on as it is. So the business is evolving around a family, where we call it as small family businesses. But there could be businesses which could have expanded globally, not only locally, but globally, where they have been running branches, offices, business operations in global scenario, where we call them as multinational corporation. Multinational corporation. So a multinational corporation means where an organization is run or having branches or operations globally, not only locally. So the next item is where we look at types of businesses, So types of businesses means what kind of businesses do we have, where, or in other words, we have to deal with. So starting with, we call them as sole proprietorships or sole traders. So I mentioned this term sole proprietorship. What does it mean? Sole proprietorship or a sole trader means organizations owned by one individual. So sometimes you might see, pardon me for saying this, there could be where we call it as a petti kade, where there is a small shop selling items in a small nature or a small scale to serve the people in the village. But this so-called petty is actually a sole proprietorship, where the business being run by one particular person, or that person becomes the owner of that particular shop. So it's very clear that sole proprietorship means the ownership is with one individual. The ownership is with one individual. But there could be situations where two friends of yours, or maybe say you and another friend, can get together and start up a business. There are a lot of businesses that we see on earth today are started like that, where two people get together and start off a business. Now, when two people get together and start off a business, we can't call that as a sole proprietorship. Why? Because the ownership is with the two people. As a result, that kind of a business is called a partnership. That kind of a business is called a partnership. So partnership is, in other words, it's a profit-oriented business. As I told you, the businesses that we are talking about here is mostly profit-oriented. We are not going to discuss in detail about non-profit organizations, which is not relevant to us. It is more out of scope topic. So we will focusing on profit-oriented businesses. So partnership is a profit-oriented business, which is run by, you have to note it very clearly, it is not only two people, it could be more than two people, more than two people. So what it means is any business that is having more than one owner become a partnership. But we need to remember that this number of persons involved in the business should be less than 20. So there is a higher limit for this number of participants in the business. So as we go on, we will see what is the difference between a partnership and a business which is having more than 20 people. So here the term partnership means it is a profit-oriented business run by two or more people, but which is less than 20 persons, less than 20 persons. Now we go to the next category, which is an organization or a business run by more than 20 people. And that is commonly termed as companies. So all of you know, we make use of this term very frequently and regularly. The term companies, very straightforward term. But the term company means a lot of things. These are called separate legal entities. Now these entities have a legal binding. That is why they are called as companies. Why it is called as companies is because they are incorporated by an act called the Companies Act number 7 of 2007. The Companies Act number 7 of 2007. So actually, prior to this Companies Act number 7 of 2007 came in, there was another Companies Act which governed all the companies prior to 2007. So with the with the introduction of this new Companies Act number 7, all the companies were registered once again under this particular Companies Act. So the requirements under this particular act, there were a lot of changes and people had to go through that process and they got themselves registered under this new act, which is called Companies Act number 7 of 2007. Now we are looking at companies and we are going to the next step of companies. So in my previous slide, where we talked about limited companies, I hope you may recall, we spoke about limited companies under legal status. So how this legal status is coming? Now with the introduction of Companies Act number 7 of 2007, you are getting the legal status. Now, under this legal status, if you are to be called as a limited company, is a company that issues shares and have the ability, or sorry, have the liability to contribute to the assets of the company under its articles. So what does it mean? Now, limited company means this company has to issue shares. Now, every topic when we start on learning, we come across new and more terms as we go on. So now the term that we have come across is shares. So let me take a simple example. You have some money and you go to a bank and you want to make an investment. So the simplest form of investment is either you can open a savings account or a current account. But since it is an investment, you would like to have a return. So you might go for a savings deposit. But as a good investor, you might not opt for the savings account because it is only paying a lower rate of interest. So you might look at a fixed deposit. Now, what is it different to a savings account to a fixed deposit? Of course, we know fixed deposit has a higher return, but when you go and invest in this fixed deposit, you get in turn a piece of paper called FD certificate. I hope everybody know about this, what is called an FD certificate is. Now, what does this FD certificate says? It says you are the owner of this amount of sum. And this is going to be with the bank for the next 3 months or 6 months or 12 months, whatever the period that you may have invested. And it will earn an interest of this much for this particular period. So you have invested money, and for that, the bank guarantees you an interest, which is your return. So at the end of the term, which we call is as at maturity. At maturity, you get the sum that you have invested plus the interest thereon. So the instrument that was given to you, which is called the FD certificate, is going to be the document which ensures that you are the owner of this investment. And you are supposed to hold this instrument until its maturity to get the money back. Now, similarly, we are talking about ownership in a company. So when I go and invest in a company, what do I get? Similar to the FD, what do I get? I get something called the share certificate. Share certificate. So what am I really going and doing is, I'm going and investing in a company's shares. So a company would decide that I'm going to issue this amount of shares to get money or to collect money to run this business. So as investors, what do? We go and put money into the business, this business, because it is going to be a profit-oriented business. And we expect a return from that business. And into that business, when we go and invest, they give us in return, which is called the share certificate. And I become the owner of the company by holding that share certificate. But I might not hold the entire company. I might have a portion of it. Because if I am going to hold the entire company, then you know it is going to be a sole proprietorship. Okay. So the number of shares that I am going to hold to that amount, I will get a share certificate. So what have I done? I have gone and given money to a company to be set up to run and do business. What is my objective? I'm going and putting money into this business. So when they make profit, they will give a portion of it to me. That is what is going to be my return compared to the interest that you got from an FD investment. So now the money that I have given to the company is in other words called the capital. So please make a note of these terms that I am talking about. Maybe you can take a piece of paper or in an exercise book. Since we are not interactive, you need to make these notes. The amount that you put into a business and obtain a share certificate means that amount that you have invested is going to be treated as the capital of this company. The capital of this company. So the company is actually divided the capital into smaller components which are known as shares, and they have distributed it to the public for them to come and invest. Okay. So what does it mean? A limited company means this company, when they run the business, they come across so much of liabilities. Now I am introducing another term which is called the liability, where there is another topic which we will describe in detail. What is liability? I will define what is liability, what is asset, and what is capital also. So liability means an obligation to pay. Say for example, let me take an example here. As we know, we consume electricity. So you consume electricity this month and you get the bill next month. So you have a liability to the electricity board to pay this amount that you have consumed in rupee terms. So that is your liability, your obligation to pay. So when a company is set up and when they run businesses, they always come across these liability, so-called liability. But what do we understand here is the liability that this company is going to bear cannot be much. There is a limit to it. There is a limit to it. So what is the limit? Where they say the liability to contribute to the assets of the company. Assets of the company. So they will oblige to the liabilities of theirs or the obligations to the extent of their assets of the company. Assets of the company. So whatever the assets that you have, again, we are coming across with another term which is called the assets. Assets is anything that is owned by you, which gives you an ownership. Say for example, when you run a business, the tables, chairs, the buildings, everything is an asset for you. So the liability here for the company is to the extent of all the assets held by the company. And where does it set? It is mentioned in the articles. Please do underline the term articles. I mean, when I say underline, you make sure that you make a note of it. The term articles means it is like the birth certificate of the company. Of course, the business registration is called as the birth certificate, but more than that, this articles is very important. As you know, the companies will be registered under the Companies Act number 7 of 2007. So you get a certificate that is called the business registration. So that is normally known as the birth certificate. But why I mention this as the article, this articles is a document, we call it as articles of association. That is the document which specifies how this company should behave. How this company should behave. So in this scenario, the limited company means where their liability is limited to the extent of the assets held by the company. Held by the company. So once we have understood this limited company, now we go to the unlimited company. So it's very easy for me to explain now. What does it mean? A company that issues shares and have an unlimited liability to contribute to the assets of the company under its articles. So which means now your obligation for your liabilities is not limited to your assets. It can go beyond that. It can go beyond that, which means suppose if you are unable to settle your liabilities with the assets that you have, you might have to bring something from home also to settle these liabilities. Okay, so it's very clear that the major component of the two companies are limited companies and unlimited companies. Limited companies is where their liability is limited to the extent of the assets held by the company, and unlimited companies are companies where the liability is unlimited to contribute to the assets of the companies. Again, that is also under its articles. So according to the articles of association, a company will not have both. It has to be either limited company or unlimited company. The next item is that we call it as state companies. State companies. So what do you mean by state companies? These are companies registered under the Companies Act, and more than 51% of the share capital. So which means I have already spoken about the term shares and the term capital. So we call it, the combined term is called as the share capital, the money that is held by the company. The share capital is owned by the government. Very clearly it is mentioned that the ownership of the company is more than 51%. So let's take a quick example to understand this. Let's say a company is formed with only 100 shares. 100 shares. So I go and buy 51 shares of that company. 51 shares of the company. Which means whoever else buys that company, the remaining shares, they will only have 49 shares. So which makes me to hold more than half of the capital or the number of shares of the company. Now earlier in one of the slides, I spoke about a term called control. You see, the term called control. Now, what does it mean by holding this 51%? 51% means out of the 100 shares, if I am holding 51 shares, means I have the better control because I am holding more than the half of the company shares. So which makes me more prominent and more control person. And what happens when this 51% or more than is held by the government, then it is known as a state company. A state company. So it's very clear, whenever you have a company holding a shareholding of more than 51% by the government, then it is known as a state company. I have given an example also. So which makes it very clear that you are the holder of more than 51% of the shares of that company, and the major shareholder or the owner of that company is going to be the government. The government. And the last one we are going to learn in the type of business is we call it as state corporations. State corporation. This is again like companies, but we call them as corporations, or they are also known as boards or authorities. Say for example, you know what is SLRC is. SLRC is Sri Lanka Rupawani Corporation. SPC, State Pharmaceuticals Corporation. Water Board. So there are so much of organizations which are run in the country by the government. Which are run by the government. So we call them as state corporations. State corporations. I have given you some comparisons between sole proprietorship and partnership. So now we know what is the sole proprietorship and we know what is a partnership. Sole proprietorship is a business where it is owned by one individual. And you know what is a partnership is? Partnership is where there are 2 or more people involved, but it is less than 20. So what I have done here is I have given advantages and disadvantages of these 2 businesses. A comparison sort of a thing for you all to understand what type of benefits and demerits are there when it comes to these 2 companies or types of businesses. So for example, we can understand no taxation at the entity level income of sole proprietorship and partnership is attributed to the owners as individual taxpayers. So this might look like little confusing to you all at this point in time, those who doesn't know about what is taxes and how it operates, all those things. So what I would suggest is let us park this for the time being. And once we go on and learn all these, what is this income tax and everything, you might be in a position to understand better what the real impact of this is. But in terms of disadvantages, you can say unlimited liability, where, as I told you, the liability of this business could be very much for the owners, even in the case of sole proprietorship or maybe in the partnership. And one other important point is where not easy to transfer ownership, that you need to understand. Now, if I am the sole proprietorship, when my business is not doing well, how do I transfer my business? It's not easy, because somebody will not come and take over my business when my business is making losses. But if it is doing good, yes, there may be more than enough people to come and take it up. But it may not happen in that manner. But in the case of companies, which I would say it's not sole proprietorship or a partnership, it is a company. Now, company, you know, it's shares. So let's say I have invested in a company with 10 shares. And now this company is not doing well. Their profitability is coming down. So what can I do? I can easily transfer my 10 shares to somebody who wants it, because it is saleable in public. But in the case of these 2, it is very difficult for you to transfer the ownership. And the next point is not easy to raise ownership capital. As I mentioned earlier, for a company, it is very easy, because what do? They estimate the required capital and they divide that capital into piece of shares, something called shares, and they put it to the public. So public can go and buy these shares by way of the stock market. But if I am running a sole proprietorship and where I need more money to run my business or to expand my business, I might have to look for support either from a bank or from my parents or from my relatives or whoever who can support me. So raising the ownership capital will be a challenging task. Even for partnerships, it is the same, because partnership means there are 2 or more people, but they have to go and find money or capital from their known parties or from a bank. So it is very difficult for you to raise ownership capital. Okay, so it is very clear that it's not easy to transfer your ownership. It is not easy to raise ownership capital also. Then we also look at some advantages and disadvantages of companies also. So I'm not going to go in detail because some of the things are very too technical. So let us park this for the time being and let's understand once we complete some of the topics later on. So this is just a comparison for you to understand what the advantages and disadvantages are. You all have any questions? So there was one question somebody has asked whether there are unlimited companies in Sri Lanka. Yes, there are. But to see that, now the term unlimited is becoming very unimportant, you see, because almost all the companies today are liable to a greater extent, because no company can escape from their liabilities in today's context, because the controls are such that in today's context, where we have a topic called corporate governance, which we may not cover in our module, but you need to know when you do go through the annual reports of your banks or maybe the competitor banks, you will know the corporate governance structure of Sri Lanka and maybe globally, where the liability has become unlimited now. So it is not specific to any company now, but more or less every company has unlimited liability in terms of running their business, because they have to be very ethical, prudent business in terms of honoring their liability. They can't escape from their liabilities in the business concern. Good, you have raised a valid question. And if there are any other questions? Okay, so let's proceed. So the next slide is on the parties interested in business or users of financial information. So I started by saying the relationship between accounting and business. So the businesses have evolved over a period of time, and their evolvement or the evolving nature is also established by a way of accounting, because the moment you start providing financial accounting information, the businesses tend to do more and more better. So there is a real relationship between the businesses and the accounting per se. Now we are coming to another important aspect of where there are people who have invested in the company would like to know how this company is performing. So the primary objective of every business is to provide financial information about the business to its shareholders. Shareholder means people who have invested in the company's shares or the business shares. So the primary objective of a business is to provide financial information required by the shareholders or the owners. But what has happened today? With the evolvement of the business and the global competitiveness, today the businesses are looked at by everyone. It's not only the shareholder, but there are more people looking at every business concern. As a result, the concept of shareholder has now got extended to a different term, which we call as stakeholder. Please note the term stakeholder. So now we talk about not the shareholder, it is about the stakeholder. Stakeholder means a person who is interested. A person who is interested or a party who is interested in the business concern. So today we are providing financial information not to the shareholders but to the stakeholders. So you have to make it very clear, because in your examination sometimes these two terms can be used interchangeably. Shareholders versus stakeholders. So you have to be very clear. Shareholder is a person who has invested in the company shares. But when you say stakeholder is a person or a party which is interested in the business concern. So who are these parties interested in the business concern? That is what we are going to look at next. So I have segregated them into different groups. And as you see, you will see there are about 4 slides, I think, on this. Yes, there are 4 slides and different categories and what they look for. So starting with, you will see the first user group who will make use of financial information is the owners, shareholders, or partners. There you see. Now I was talking about stakeholders. The stakeholder term includes the shareholder. So shareholder has now become a group within the major topic of stakeholder. It is true that the companies should provide financial information to the shareholders because it is a compliance requirement, but now it has gone to the extent of providing it to the stakeholders, the larger population. So we will go one by one to look at who are these stakeholders are. The first type of stakeholder is where the owner, shareholder, or the partners. So as you know, some examples would be, in the case of a sole proprietorship, there is individuals, where as an individual, I will hold shares of a company. There could be insurance companies who have invested in the companies that we are talking about, and there could be prospective investors or people who have invested already. So what are they looking for? To decide on the investment, that is, now if I am a shareholder and if I have invested in a company, what is my expectation? I am expecting a better return for my investment compared to my example previously, my FD investment, where I was expecting a higher interest for my FD. But what am I looking at here? I have gone and invested in this company in certain number of shares to obtain a return. Now, at this point, I would like to introduce another term, that is, what is the return that you get when you go and invest in a company's shares? Does anybody know? Can send me an answer by way of a chat. Does anyone know what is the return that you get when you go and invest in a company's shares? Very good. I am getting a lot of answers. So there are people who know about this. Very good. So for the benefit of those who doesn't know, let us introduce another term which is called, now in the case of a fixed deposit, you know you get interest. But when you go and invest shares in a company, you don't get interest. What you get is called dividends. The term is dividends. D-I-V-I-D-E-N-D-S. Dividends. So what the company does is, when they make profits, as you know, the profits are made out of the money given by the shareholders, and they are the owners. But the company may be run by somebody else. Okay? So the people who are running the business should give back something in return to the people who have given money to run this business. So the return that they give is called dividends. And how this dividend is given is by way of an amount per share. Okay? By way of an amount per share. So for example, they might say, we are going to pay 5 rupees per share. 5 rupees per share. So for example, if I am having 10 shares in a company, the dividend that I would get is 50 rupees. 50 rupees. So you might think it is a very small amount. No. When you look at companies in large, the number of shares that you may invest could be very huge. So as a result, the amount of dividends that you might get will be very large sums. But there could be situations where you might be holding a smaller amount of shares also, so which might only reap a smaller amount of dividend. So the point here is, it says to decide on the investment. Now, if a company is not making profits, what is my situation? I have invested money in this company, expecting them to pay me something in return, but now this company is continuously making losses. So I have my doubts about my investment. What do you mean by that? This company might not pay anything as dividends to me. So as a result, now I have to make a decision whether I should keep this investment or not. So the best option that I have is immediately sell my shares to somebody else. Sell my shares to somebody else without getting into more trouble. You know why? The moment the profitability or the level of profits of a company comes down, the price of that particular share in the stock market also comes down. It is only one reason. There could be so many other reasons, because you might know in the current context, there were situations where our stock market couldn't perform also. Okay, so there could be external factors also which will have an impact on the share price. But what I am saying here is only one other reason. That is, the profitability of the company is also an important determinant of its share price. So when a company makes, or company is making a lower level of profits or losses, what happens? The company's share price might come down. So when the share price come down, you know that your investment is not going to be worthwhile. So you have to make a decision now, whether I'm going to hold it or I'm going to sell it. Okay. So from a user perspective, as a shareholder, what do I want to know? Looking at the financial information of the company, I need to decide whether I'm going to hold this investment or not. Secondly, to decide whether the organization can distribute the dividends. Now, there could be situations where the company might have profits, but they might not have cash to distribute dividends. Now, these two are very contrasting topics, which we might learn later on, where we say it is a question of profitability versus liquidity. Profitability versus liquidity. Liquidity means the level of cash or cash holding that you have. So there could be a situation where a company might be making profits, but it doesn't mean that they have adequate cash. So even though sometimes what happens, companies might make profits, but they are not in a position to distribute them as dividends because of the shortage in cash or limitations in cash. So the financial information that you obtain from this company will give you an idea how strong this company in terms of liquidity, or how strong this company in terms of profitability. So you can make for yourself that whether this company is capable of distributing dividends for me in the future or not. If you think that the company is not going to distribute dividend, better you quit with your investment. You quit with your investment, because there may be more and good opportunities in the market where you can invest that money and get a better return. So this happens sometimes to us also. You go and put a FD in one place and you get to know there is another opportunity where they are paying a higher rate of interest. So you might want to take it from this particular organization and put it to another organization. So that kind of a thing can happen even with businesses, where you have invested in one company and you get to know, or you make yourself understand that this company is not going to give you better returns. You quit from that company and go and invest in another company. And thirdly, as a shareholder, I would like to know whether this company is going to be stable. Now, if I am going to continue with my investment, I need to know that this company is going to be stable for the known future or unknown future. This is actually leading into a concept where it is called the going concern, which we will learn shortly in upcoming topics, where every company should have a going concern, where they say that they are going to continue to the unknown future, which means they don't have a set target to close down the business after a certain period of time. Their continued motivation is to run this business forever. So if your motivation is to run this business forever, means you have to be stable enough to run the business. Otherwise, what will happen? You can become bankrupt. So bankrupt means you are broke. You can't run the business. So the financial information that you provide to a shareholder will give them an understanding of how stable your company is, whether you can continue the business for the near future, at least for the near future. So the shareholder can make a calculated decision about his or her investment in the company. So that is the first type of stakeholder. Please make a note of it. It is the first type of stakeholder where we talk about owners, shareholders, and partners, and how they make use of the financial information provided by the businesses or the companies. The second type of stakeholder that we are going to look at is the lenders. It is the lenders. Now, say for example, we are running a business and we have our shareholders, and there could be a time where the money given by the shareholders may not be sufficient to run the business. So you might need additional money coming into your business. So what are the options available to you? As a business, you can go to a bank to borrow from the bank. We call it as borrowing. You ask for a loan. So right now also there could be customers who are coming to you with businesses asking for loans. So what do? They want capital in the form of a bank loan. Or there could be customers who are going to finance companies. When the banks are not giving them loans, sometimes they might go to finance companies to get the loans. Or for that matter, they can go to leasing companies also. So the banks, finance companies, and leasing companies, or maybe for that matter, any other financial institution, they become the lenders to these companies. Now, why do these lenders want to have the financial information of this business? Because to ensure the ability of recovering the capital and interest, very important. Please note that the ability to recover the capital and interest. Now, in today's context, as banks, we have given loans to many. And under these COVID-19 conditions, recovering the loans have become very difficult task. And the central bank has also requested us to give moratoriums. Why is that? To encourage these businesses to come out of this pandemic and recover themselves in the business in the next 3 to 6 months, and then start repaying the loans to the banks. So from the bank's point of view, before I give a loan to a customer or to a business, I need to ensure whether this customer or the business is capable of repaying the capital and interest to me, because I'm not going to give money freely. For every loan that I give, I charge an interest, say 12%, 14%, whatever. So beforehand giving the loan, I need to know whether this customer or the business is capable of repaying me the capital as well as the interest that I'm going to charge in the future. That is number one. Then we also talk about something called security. Security is another term that we are going to make use of during our course. So what is the security? Security means the collateral that is going to be given by the customer. Say for example, you give a housing loan to a customer. So what do? You take a mortgage over the property for which you are giving the loan. So the property that you are taking as mortgage is called the collateral or the security. So looking at the financial information, these type of information can be obtained by the lender before giving the loan to the customer. The customer here could be a business concern or it could be an individual also. But what is important for us to understand is, from a lender's perspective, I need to know whether this customer is capable enough to repay me the loan amount that I am going to give, together with or without the interest. So the second type of stakeholder is the lender, and why it is important or what is the use of the financial information for them is to ensure the ability of recovering the capital and the interest for the loan that they are going to give. The next stakeholder is the general public, like you and me. When we want to invest in companies, we look for certain things. And among those is one aspect of the financial information. Among those are financial information. So when you say general public, there could be political parties, there could be local communities, there could be consumer groups. So there are so many components of general public. The major category is general public, but there are smaller components. So we would like to know whether the company products are good for the public. As a consumer group, I would like to know the products of this company are good for public or not. Whether the company operations badly affects the environment or not. If I am a responsible citizen, I should always ensure that I am not making any bad effects on the environment. But as a general public, I would like to know from a business whether they are contributing towards any of these activities. When you look at their financial information, you might come to know whether what is the type of business that they are running on. What are the products and services that they are offering? Whether those products are good enough to the public or making good operations or making badly affecting the environment. So the extent of financial information is not only numbers, but also there could be characteristic information also. In general, we call them as qualitative and quantitative information. Whenever you get numbers, you call it as quantitative, but when you say financial information, it could be qualitative information also. Qualitative information also. The next stakeholder is the management. So as I told you earlier, we know the owners of a company is going to be the shareholders, because they are the people who have put money and they are the people who are owning the company also. But have you seen any company that is being run by the shareholders? No. So the shareholders, what do? They appoint a set of people to run this business. The first category that they appoint are called the board of directors or the directors. So the directors are the people who are going to run the business on behalf of the shareholder. So as a result, here there is a relationship between the shareholder and the board of directors. This relationship is very important and we call it with a special name. That relationship is known as principal-agent relationship. You might come across these two terms in other subjects as well, but when it comes to businesses, this is one important term where there is a principal-agent relationship. So the principal being the shareholders, the agent being the board of directors. What does it mean? The principal wants this business to be run in the appropriate manner to make better returns. So they appoint the agents who are called the board of directors to work on their behalf. So the agents have a responsibility, being the people appointed by the shareholders, to run this business in the right manner and give them a better return. So what does this board of directors do? Now they can't be running the business, so they hire people. They hire one person called the CEO or the chief executive officer or the managing director. Of your respective organizations, you will have a person called chief executive officer or the managing director. And above him, there could be the board of directors. And under the CEO, what happens? There are the corporate management, senior management, middle management, divisional heads, managers, other staff working. So there is a huge amount of staff strength that is created to run this particular company. But what is more important is to understand the principal-agent relationship. So the principal is the shareholder, the agents are the management, which includes the board of directors, CEO, divisional heads, and everybody. So now we need to know why these people, the management, needs this financial information. So starting with, we can say whether the status of the company is good when compared with competitors. Now it is very important for the directors and to the management team to know their level of performance in terms of comparing it with their competitors, because today the market is such that there is a huge competition. So every company is competing with each other. Now it's not the case with where a bank is competing with another bank. Now it has gone to the next level where the bank might compete with a manufacturing organization also. So in order to understand the level of competition and the level of performance of these competitors, these management teams need to know what is the performance of its own company. So they need the financial information of the company for them to carry out a comparison. And more importantly, as I told you earlier, companies are mostly profit motive. So the people listed here as management, they are very much concerned whether the profit is adequate. Now, if you are not making adequate profit, then this company is going to get into trouble in the near future, which we call it as you have to make sustainable profits. Please make a note of that term, sustainable profits. What do you mean by sustainable profits? The profits that you are making today has to be in a position to be taken forward to the future. You should not make a profit today and lose it the very next day. So the sustainable profit is what is going to make this company much more stronger in the future. So the management team is always concerned about this because they are the people who are managing this business and they are answerable to its owners or to the principal or to the shareholders. So as the management team, one of the stakeholders of this company, they also need to know financial information for their decision making. Next, we come to a very interesting category, like all of us here. Employees. So as you know, employees can fall into factory employees, office employees, there could be trade unions. So why it is important for us as workers of organizations and employees attached to banks, why it is very important for us to know financial information? Can any one of you give me any answer? Why do you think that as employees, we are much more interested in the financial information of this company? Yes, very correct. I am getting some answers saying for salary, ensure job security. Yes. So, you know, you are working there to earn a salary. So you need to know whether your company is making good or making adequate profits for you to make or pay salary in the future. Because I need to know whether working with this company is worthwhile, whether they will be in a position to pay my salary. So that is what this point is. How much of salary will be bearable to the company? Now, under today's context, you might have heard under this COVID-19 pandemic, there are companies who have gone into the level of pay cuts. So why is that? Because they might have come to a situation where their profits may not be sustainable. In order to make it sustainable, they need to take few precautionary actions. One such action is the pay cuts. So it doesn't mean that doing a pay cut will ensure that you are sustainable, but these are some of the actions that you might take. So as employees, we should be knowing about our organization, the financial information, to understand whether this company is going to make sustainable profits in the future for me to pay salaries to me. Secondly, whether the company will survive for a long period. Why that is important? That is where one of you have answered, to ensure your job security. So I need to know whether my job is ensured. If I am asked to leave my organization tomorrow, I'll be in a trouble. So it is very important for me to know whether this company could survive in the long term, so that I will not lose my job until I retire or I make my own decision to resign from the organization. So now you might be very clear with what is the expectation of the stakeholder group of employees when it comes to financial information. Then the next category of stakeholder will be the suppliers and creditors. Suppliers and creditors. So suppliers and creditors means people who supply raw material for your business or the required stationery or other services to your business are called your suppliers. And when you are required to pay them back for the services or the material that was provided to you, they become creditors to you. We learned this term creditor in detail in a different topic. So for the time being, you remember a person who has provided you material or service and they are supposed to get a payment from you, means they become your creditor. And there could be subcontractors also, where people involved in doing subcontracts, they are also part of the business concern, where they will be interested in to know how this company is doing. Now the question is, why suppliers and creditors should know about this organization? Because today you are providing services or raw materials to this business thinking that they will pay you for the supplies that you have done. But if the company is not performing well or they are making losses, what is the guarantee that you will get the payments for your supplies or services that you have provided. So these suppliers and creditors would be interested to know whether the company is a major customer at the moment, which means whether I am catering to a customer who is very important to me. Secondly, whether the company is in a position to settle debts. So please note the term debts here. Debt means your obligation. As an organization, I am supposed to pay these suppliers and creditors for the raw materials and the services that I have obtained. So when I am supposed to pay means that is a debt to me. So the suppliers and creditors will watch me carefully, my performance, to see that whether I am in a position to repay them. The moment I show signs of not paying them, they will stop their supplies and providing services. Let me take an example. We assume that there is a supplier who is supplying stationery to your bank. So your bank is now doing well, and this supplier is happy with you. So he continues to provide you supplies, even without money immediately, where they give you some term, credit period. We call that as credit period. So you can pay the supplier after 2 months, 3 months, likewise. Now, all of a sudden, your bank is showing signs of not performing well. Now, this will create a small question into the minds of this supplier. So I have been supplying stationery to this bank when the company was doing, the bank was doing well, and they were making all the payments to me on time. Now, all of a sudden, this bank is showing signs of not performing well, or they are having a decreasing term of profits. So this supplier would now think whether I should continue to provide stationery to this bank, or should I stop this at this point in time and recover for whatever that I have already supplied. So this is the level of financial information that the suppliers and the creditors will look for from a company's financial information. And lastly, government and other regulators, very important. So you know, government and other regulators are also a part of stakeholders to the companies or to the businesses. Now, who are these stakeholders coming under the category of government and other regulators? The tax authorities. Why? The Inland Revenue Department is very much concerned about companies' performances because they collect taxes from these companies, because that is the biggest source of revenue for the government. So there are various types of taxes which are collected, and that activity is handled by the tax authorities, the Inland Revenue Department. Then the stock exchange. The stock exchange is the place where the shares of companies are traded, where people buy and sell their shares in the stock exchange. So they become as a regulatory body. So the stock exchange has a responsibility to see that when the companies are not performing well, to caution them, because it might create an ambiguity or a downturn in the stock exchange also. So it is very important for the stock exchange to get these financial information to ensure that the public interest is preserved, because people are going and investing in companies thinking that they will have a better return. The moment the returns are low or coming down means they will lose the interest in the companies to go and trade in the stock exchange. So the stock exchange continuously monitors the performance of these companies, and they ensure the compliance part of the companies is complied with. The next one is the central bank. As you know, Central bank is the regulator for all the banks operating in this country. So what is their task? They will ensure that banks are operating in good status or in good condition, because that has a direct impact to the monetary system of this country. Therefore, the central bank plays the role of regulator to monitor continuously and look for compliance of these companies or the banks in this country. And we might also have the consumer authority, which looks for prices, price stability of goods and services, and the goods produced in the market are of good condition. So there are so many things happening, and all these were the talk of the town today under this COVID-19 pandemic conditions. So as you know, these are the stakeholders which are coming under the government and other regulators. There are so many other which I have not listed. But what are they look for? Whether the company has paid taxes, so which relates to the tax authorities. Whether the company has adhered to the regulations, that is again to something to do with the stock exchange. Whether the disclosure requirements in financial statements have been made, that is to something to do with the central bank. Whether the activities of the company is detrimental to the customers, something to do with the consumer authority. So there are likewise, you can find so many examples, and the level of information that they require from these companies to ensure that the public interest is preserved. So we have looked at almost 7 different kinds of stakeholders at large, but you might have so many other examples or maybe categories coming under this, but I have grouped them into 7 broader categories, which is adequate for you to answer even in the exams. What is important is you need to know these examples under each stakeholder group and the level of information that they look for. Sometimes you might get a question in the exams where they might ask for the stakeholder groups, please note that. And under each stakeholder group, you have to give one example and the usefulness, what they look for in the financial information provided by a company. So I hope it's clear with regard to the parties or the stakeholders interested in businesses and the level of information that they look for. Do we have any questions? Okay. Thank you. Right. So moving on with the session. Now we look at the last topic of this area where it talks about the accounting environment. So as you know, the businesses operate within an accounting environment. We call it as accounting environment. So what do they need to do under this accounting environment? The accounting environment is broadly classified into 2 types. We call them as internal environment and the external environment. So by this time, you know what could be this internal environment and what is this external environment is. So we talked about 7 groups of stakeholders. And out of these stakeholder groups, there was one category which said management. Who were they? They were the people who are managing the business on behalf of the shareholders. So stemming from that point, we can understand that the internal environment of accounting environment of a business is where it could be controlled by the management. Please note the term management. The management means that is this particular category of people or the segment that I was talking about, where these people are the people who are going to control the internal accounting environment, which means all other categories are the external environment beyond the control of the individual business, and the business may have to adjust itself. So which means the external environment is anything beyond the management of the business, that is internal to the business. So everything else is going to be external to the business. So within this internal environment, we have people where the shareholders, even though it is included under this category, you need to know it's more towards the management that we are talking about, the managers and the employees. But you might see another important aspect within this broader topic of internal environment, which we call it as an entity's nature and culture. So this is one of the important aspects in today's context for every business organization. Every organization has its own culture, which they have been building up over the years and which they intend to build up in the future also. So your internal environment is also made up of this entity's nature and its culture. I don't need to explain in detail what is the culture of the organization is, because every organization they have their own specific culture which is relating to their organization. So the internal environment is basically built up with these components, where you say the shareholders, the managers, the employees, and the entity's nature and culture, which is also an integral part of how we behave and do the business within the organization. When it comes to the external environment, as you know, we were talking about various other stakeholders of the business. Now, how these different stakeholders can be related to the external environment of the organization or the business. You see, the first aspect is where we call it as the legal aspect. So the legal aspect means where you come into the picture, where the regulations are coming into the picture of a business. Say, for example, the central bank. The central bank comes into the picture as a regulator. So regulator means they look at it from the point of view of the legal aspects or maybe the regulatory aspects of this organization. So the external environment is more towards these regulators and the government in terms of the legal aspect of the external environment. Then we also have economical and political. So some of the policy decisions made by the government or maybe the central bank introducers are also will impact the organization itself, because some of the policy decisions are also made based on the strength of the performance of the banks in this country. So the monetary policy is built up to ensure that the monetary system of this country is strong enough to take it forward. Then we also have organizations and communities looking at organization where they deal with the social and cultural aspect. How these organizations are operating, what are the ethics that they are following, those are very important. Then the next aspect is where we look at the technical and professional aspect. When it comes to the external environment, there are so many professional bodies working around the country to ensure that the companies have sound governance. For example, I can quote one company, institution is the CA Sri Lanka, the Institute of Chartered Accountants of Sri Lanka. We call it as CA Sri Lanka. So they are the professional body which governs and ensures strong governance and strong ethics being followed by the companies in terms of financial reporting. So the biggest strength of this country is the CA Sri Lanka to make these companies providing financial information to the stakeholders as it is expected in a greater extent to make them aware about the company's state of affairs in terms of financial performance. And likewise, there are so many other organizations involved in monitoring the business organizations with regard to their external environment. And finally, one aspect is the technological enhancements. As you know, today, banking is purely based on or melt around with technology. Who has the technological edge becomes the pioneer in the banking sector. So the technological enhancements also have become more and more important as part of the external environment of organizations. It is not only the banks, but it applies to any company for that matter, because every company is looking at systems and procedures to enhance their business operation. So the technological advancements or enhancements will have a direct impact of the business concern, and it will have a direct impact for the accounting environment also. Because today the accounting systems of companies are, you might know, that it is always some computer systems. It is hardly you see that people are still making use of the manual bookkeeping. Even though our module will go on the basis of manual bookkeeping, we don't look at the system operated accounting systems in our course, in this particular course, because what we learn here is considering the manual bookkeeping. That is why we are learning all these. So even though we learn on the basis of manual bookkeeping, but today the organizations are operating with computer systems. The technological advancements have impacted the companies in a great extent in terms of the accounting environment or the external accounting environment of the organizations. So lastly, out of the last topic of this chapter, where we come to the last topic of this chapter, where the internal organization or the internal environment of an organization, as I mentioned earlier, is made up of the managers, employees, and then entities, nature, and culture. But how these are managed within an organization, So as you know, you might have in your respective organization so much of committees operating, looking at various aspects of your organization. Some of the common committees that you might come across in your organizations are, number one, we can say the executive committee. Very important, the executive committee. What do? They govern or they administer or the administration. For example, the board of directors. So you know, the decisions for your organization is made by the board of directors, the people sitting at the top. They are sitting at the top of the organization hierarchy where they make the decisions for your organization. And those decisions are then comes down to the bottom of the organization hierarchy through different levels to take forward the decisions into actions. So the executive committees are always, which is made up of board of directors in looking into various aspects of the organization. So one such executive committee is where you can say the board audit committee. So the board audit committee is very important. We will learn towards the latter part of this course, where under statutory requirements and regulations, where we will have to know what is the function of an audit committee is, board audit committee. because they are the people who are going to approve the financial statements of an organization. They have the sole authority to peruse the financial statements prepared by an organization, and they will recommend to the board of directors for publication to the public. So it is very important to know there are different executive committees operating in an organization to looking into various aspects of the organization. So you can go through maybe a company's website, or maybe for that matter, you can go through your own bank's website to look at what are the board committees that you have, or what are the committees any other company might have, and look into who is operating within those committees and what is their scope, what is expected out of them, how do they perform. So many things can be understood. Secondly, we will have standing committees. So the standing committees is basically formed for a particular purpose, and they might operate on a permanent basis. Say, for example, your credit evaluations, how the credit should be performed in the respective organization, in your banks. So there could be a standing committee which evaluates the performance or the procedures, the controls that you have on a permanent basis. Say once in every quarter, or maybe once in every month, they might decide, and they can look into these aspects of your organization, procedures and controls, by forming a standing committee. This standing committee is mostly made up of the management. Either it could be corporate and senior management, or it could be of the middle management. Then we will also have ad hoc committees, where when there is a special task, you will form a committee. So you know what is these committees are formed normally. For social activity also, we will form different committees. Likewise, in organization also, they might form ad hoc committees to complete a particular task. So all of a sudden, let's say you are going to implement a system or software system in your bank. So you will form a special committee which will look into the implementation of this software system in your bank. So those are called ad hoc committees. Then you might also have subcommittees. These subcommittees are the committees appointed by the main committees to assist them. So for example, an executive committee might appoint a subcommittee to take forward the decision made by the executive committee. Or in other words, in order to make decisions at the executive committee, the subcommittee will help them by giving them the required inputs. So more or less, the subcommittees are a branch of the executive committee, a branch of the executive committee. And finally, we might also have management committees. The management committees are again to take or make decisions for operational matters. So you need to understand, as I spoke about, the shareholders are the people who are the owners of the company. And they have appointed the agents who are the board of directors to run this company and provide them a better return. So what happens here? The board of directors make decisions for the company to make profits and provide a better return for their parents, who are the principal, which is the shareholder. But the board of directors cannot act on floor to make these operations. So in order to carry forward their decisions, they have management committees. So they only take forward the decisions made at the board level, which covers the operational matters of the business concern. So it is like a combination of all these committees that run a business concern. So even though we say some common committees, there could be various types of other committees operating within an organization. But it is always the combination of all these committees which are going to help the performance and the operations of an organization. So that brings us to the end of chapter 1. And if you have any questions, you may ask now. So I think I have the mic is always on unmuted, so you can ask any questions, or you can post your question also where I can answer. We have another 5 to 6 minutes if you want. So I hope the topic that we covered today gives you an introduction to what we are looking at and what we are going to take forward and to understand during the next 20 weeks or so, to understand what is expected out of this module or the course. And I also believe that I was very clear in terms of the voice, and the slides would have been clear to you all, I hope. Yes, there is one question where it says non-executive directors also participate in meetings. So what does it mean? When we spoke about executive committee is made up of directors, board of directors. Now these directors have two components. We call them as executive directors and non-executive directors. What do you mean by executive directors is mostly when an employee is part of the board of directors, then they become executive directors. So in organizations, you might see mostly the managing director is also a member of the board of directors. So which means within the board of directors, the executive director is the managing director and all other directors become non-executive directors. So likewise, when a meeting happens, when you say that it is a board meeting, the board meeting will consist of executive directors as well as non-executive directors. But when it comes to a standing committee, it need not have the both. Sometimes it will be a combination of non-executive directors who will be running the show in a standing committee. But when you say board of directors, it is the inclusion of an executive director or maybe one or two executive directors and the non-executive directors. Good question. Any other questions that you want to clarify? Yes, there is one question which says example for each committee. So first one we can say the board itself is an executive committee, the board of directors. When you say the board of directors, that itself is a committee. So the first one is actually, the example is already given, the board of directors. And when you look at standing committees, say, for example, we might say, we can say HR steering committee, where they will look at the HR aspects of the organization. So there will be a committee formed with the inclusion of several directors to discuss the HR aspects of the organization. Then we can say ad hoc committees. So the ad hoc committees are, as I told you, it is for a particular task. Say you can call it as a project. There is a project which is undertaken to implement a system software. So in order to implement that system software, there will be a project team. But this project team will have to report to a committee. And that committee is known as a project steering committee. So the ad hoc committee will be something like a project steering committee. Then we also have subcommittees, where I told you that it is a committee that is appointed by the executive committee to assist them. So you can say this is a subcommittee, could be the credit policy committee. I'm looking at from the point of view of a bank, where you can say the subcommittee could be the credit policy committee. Then management committee, very important. I told you that the executive committee will look for this management committee to take the decisions pertaining to operational matters. So the management committee, where it comes to the banks, very important. We have a management committee called ALCO, ALCO. What does it mean? It is the committee which looks after the assets and liability management of the bank. So we call that ALCO committee, assets and liability management committee, ALCO. We call that as ALCO. Any other questions? Okay, so I hope we were very clear on what I was trying to explain today. So hope you have a clear idea about what we discussed today, and I want you all to go through again these particular notes, the slides that I was given, and also please make sure in future sessions that you make notes pertaining to these, either in the form of printed slides, or maybe you can have an exercise book to make notes wherever reference to the slide. And make sure that you take down these notes whenever I give those points within this slides itself, because it might give you a clear picture when you go back and do the revision work pertaining to these subject components. So thank you very much, and hope to see you again with another session.